Keenan, you might just tell me there when there's enough people in and we can go.
Yeah, perfect, David. Numbers are flowing in now, so I'll get started.
Hey to everybody who's after joining us so far. Really appreciate you coming on today's webinar, particularly when it's the Thursday before the Patrick's Day weekend. My own name is David Looney and I work as a financial planner with Alpha Wealth. I am joined by some of my colleagues in Alpha Wealth on the call today, and we will be kind of monitoring the chat box on the webinar throughout it. So if anybody does have any questions, look, please feel free to pop them into the chat box and we'll do our best to get to them throughout or at the end if there's time. So over the next kind of 30 minutes or so, we're just going to be kind of running through some various different aspects of personal finance. And look, I'm positive that there is going to be some really beneficial takeaways for everyone to get from that. Just before we go into things, for those of you on the call who might not be familiar with us or maybe on these webinars for the first time, Alpha Wealth basically run a impartial financial planning and advisory company. We've 8 qualified advisors in Alpha Wealth who've over 60 years of experience between us. We basically work with individuals like yourself in pretty much all areas of personal finance. We specialize in giving advice in areas like savings and investments, retirement planning and pensions, tax reduction, protection, mortgages, and other areas like that. We also act as I suppose an independent broker of financial products. So look, it's all about, you know, reducing fees for clients and getting them access to the best options in the Irish market. We have been doing a lot of these webinars over the last couple of years, and the next one that I'll be doing myself will actually be on the 18th of April. It's going to be an evening session at 7:30 p.m. focused on how you can prepare for your kids and grandkids' third level education costs. Obviously, it's a big financial burden for a lot of parents. So if anybody is interested in coming on that webinar or any of the other ones that we are doing, you can kind of follow our main social media channels like Twitter, Facebook, and Instagram to find out a bit more information on them. And we can, of course, update people on upcoming webinars through email as well. So anyway, back to today's webinar, which is financial advice for pharma and medical device employees. So from my side, I've been in financial services now for about 9 years. So I've dealt with, you know, a lot of clients in different positions, different circumstances, and where we're based ourselves is in a place called Little Island in Cork. So we're surrounded by pharmaceutical companies, and we're quite used to dealing with employees of the pharma and medical device sector and giving them, you know, specific financial advice for their situation. I find that, you know, many of them are quite well paid, but of course that comes with, you know, hefty tax bills. And I find that individuals are sometimes unaware of maybe ways to mitigate against those, you know, high tax, and maybe they're unsure exactly, you know, ways to manage their finances when it comes to things like pensions and share saving schemes and how much should be allocated to each one. So I suppose that's where we come in and, you know, help people manage their finances and their assets and their income a bit better. The 5 key takeaways really of today's presentation are firstly going to be around establishing your financial goals, which is always, you know, first step for me, most important thing to address. We're going to be talking a bit on ways that you can reduce the tax that you pay, achieving financial independence before 60, what to do with company shares, which I appreciate mightn't be relevant to everyone on the call today, but, you know, might be for a large cohort. And finally, again, just some BIK changes around company cars that and ways to mitigate against that, which might impact some of the people on the call today. And as I mentioned, we will open it up to a Q&A as well. So as I said, the first step for me is all about, you know, establishing what your financial goals are. When I meet a client for the first time here, I always try to delve into exactly why they're speaking to us or what they're trying to achieve. And I hear things like becoming debt free, being able to buy a property, building up a nest egg or a portfolio, saving for their kids' third level education, saving so they can retire at a certain age or become financially independent, ensuring their family are looked after, reducing their tax, and maybe a combination of all the above. And what I stress is that it's so important that all of us have a roadmap or a financial plan on how we're going to achieve all these things. So rather than just kind of throwing random amounts of money into bank accounts and shares and pensions, it's really about putting a bit more meaning into things and making sure that the right amount of your money is going into the right places to achieve your goals. And that's really, I suppose, where my role as a financial planner comes in, and, you know, helping people get the right balance when it comes to distributing their income between needs, wants, and saving and investing for the future. So just leading into, I suppose, reducing your tax, the, I suppose, poison chalice maybe of, you know, being paid quite well is that we suffer some of our income to the top rate of income tax, which is 40%. When combined with USC and PRSI, you're talking about, you know, about 52% tax on maybe a large chunk of your income. So I just want to run through some options that are out there for people to maybe put a little bit back in their pocket and reduce how much is going to the tax man. Firstly, obviously, we have, you know, the smaller things like making sure you're availing of all the reliefs and credits, which include things like working from home, rental credits, health and dental expenses, tuition fees, and flat rate expenses. But I suppose the three kind of bigger ones that are maybe an option for most of the people on the call today will be pension contributions, company share saving schemes, and a tax back scheme called the Employment Incentive Investment Scheme, or EIIS for short, which I'll be spending a bit of time discussing as well. The first thing I want to talk about is your pension. And while I don't want this to become a pension lecture, I think that a lot of people still don't realize the value of their pension and maybe aren't fully taking advantage of it. Particularly if you have a company pension scheme where your employer is making contributions, you're getting free money from two sources. It's money for jam. You're obviously getting the matching contribution from your employer, and then you're also getting free money from the taxman in the form of a 20% or 40% tax saving, dependent on what level of income you have. So if you think about that, if you put €100 to your pension as a top rate taxpayer, your company is matching it by 100, but your 100 is only costing you 60 because of the 40% relief. So for every €60 going to your pension, or for every €60 you spend, you could essentially be getting €200 to your pension account, which is the employer contribution plus the tax relief. And you also get tax-free growth on all of those contributions. So a pension really for me is kind of like a savings and investment account on steroids. And I think people should be, you know, putting a bit more focus on that. So for example, if you have somebody on a €70,000 a year salary who's in a 5% and 5% company matching scheme, that's £7,000 per year going to their pension. But what it's costing them is only €2,100 a year. That's a 340% return before the money is even invested. I think most people on the call would struggle to show me an alternative where they're going to get a 340% return on their money before the money is invested. You're not going to get that from property. You're not going to get it from, you know, buying shares in the company you work for, respectfully. So, you know, the pension for me is the most powerful tool in your armory to significantly reduce your tax bill and accumulate wealth in a very, very efficient manner. And the scope that people have to fund their pensions is quite generous. You'll see the limits over here on the right hand side. So for those who are under 30 years of age, they can put 15% of their earnings into a pension, and that gradually increases to 40% for those who are 60 or over on that scale here. Now, I'm not a big fan of the term retirement because I think the, I suppose, idea that somebody fully hangs up their boots at 60 or whatever and, you know, retires on a beach is a bit unrealistic. I prefer the term financial independence. And basically, financial independence is defined as having sufficient personal wealth to live without having to work actively for basic necessities. For financially independent people, their assets generate income that is greater than their expenses. So we really need three things to achieve financial independence. We need an income stream that's going to be more than our expenses. Ideally, we need to have no debt or limited debt, and we need to have provisions in place that are going to cover all future large expenditures, such as, you know, children's education costs. So again, I suppose my role as a financial planner is getting people to the point of financial independence as soon as possible. And for most of us on the call today, our pension is going to be our main route to financial independence, which is why we should put, I suppose, the right amount of focus on it. Now, I do believe that financial independence is a lot more achievable than most people think. And to prove to you guys why that's the case, I'm actually going to show you my own pension projection here, my own roadmap to financial independence. So my goal is to be financially independent at age 55. And maybe I won't achieve that, or maybe I will. But the key thing is that at least I know what I'm looking at. and we can do these pension projections with any client who wishes to deal with us. And it's really about seeing what you're on track for, seeing if there's a deficit, and putting a plan in place to make it up. So just to take you through, because look, I appreciate this is quite heavy. I'm 31 at the moment, and the aim is to be financially independent at 55. I've about just under 31 grand in my pension pot at the moment, and there's €1,000 a month going in there. Now, remember, I'm not paying €1,000 per month. I wish I was. Some of this is coming from my employer, and some of it is coming from the tax man. So what it's actually costing me is only €450 per month. And under a very conservative projection, my pension pot at 55 is going to be worth about 826 grand, which is going to give me a 25% tax-free lump sum, which is the max tax-free cash you can take from a pension of 200,000, and then an annual income of 31 grand per year. So as I said, maybe this isn't enough to replace my income at that point in time or cover my expenses, but it's certainly a good start. So saving 450 per month, or just €104 a week for me here, is building up a fund of about 826 grand by age 55. And this is what I'm talking about, of being smart and using your pension to accumulate wealth in a very efficient manner. And of course, I'm after saving tens of thousands on tax in the meantime. So how many people on the call today are putting 100 a week or 400 a month to their credit union or their bank, where it's earning nothing and they're losing 40% tax to do that? Now, I'm not saying that people shouldn't be putting money to their bank or savings accounts. They absolutely should. But it's coming back to this thing about having the right balance and, spreading your income towards kind of short-term, medium-term and long-term vehicles.
David, can I just interrupt you there? A question
Yep.
came in. There's just two questions. So the first one is, what is the maximum amount I can put into my pension? And the second one is, what should I do if I have a defined benefit pension? Any advice? So if you can.
Yeah, so the first question, I'll just go back to the slide here. So this is your scope to put money into a pension. Now, the one thing I will say firstly is that your earnings for the purpose of calculating your scope are actually capped at 115 grand, which is sometimes where people get caught. So like if you're earning 150 grand a year, you can't put, and you're say 42, you can't put in 25% of your 150 grand. You can put in 25% of 115,000. Now, that does not include what your company is paying in. So if you're somebody who's on, say, 100 grand a year, you can put 25 grand a year into your pension if you're in this age cohort, and your company can also fund your pension massively on top of that. The second question about defined benefit, Keenan, is it?
Yeah, David, yeah, please.
Yeah, so a defined benefit pension works a little bit different to what I have going on here, which is kind of like a savings plan on steroids, as I put it earlier. A defined benefit pension is basically your company telling you that if you work X amount of years with them, they're going to give you an income of whatever, 31 grand a year here in this case. And I suppose all the kind of investment side of things is not really relevant. Now, I suppose the challenge people might face is that a lot of defined benefit pensions have a retirement age of 65. So if you want to get yourself in a position where you're going to reach financial independence earlier, your defined benefit is likely going to be reduced. So you can do something to, I suppose, bridge the shortfall. And that's to start an AVC plan, additional voluntary contributions, which are just making kind of pension contributions here, no different to my own. And you're basically kind of working up a fund alongside your defined benefit to allow you have more income in retirement and maybe retire at an earlier age. So hopefully that answers the question. So just kind of moving on from that, I spoke about making sure that you're putting the right amount of money into your pension, but it's so important as well to make sure that you're getting access to the best funds that are available within your pension. And this is related to defined contribution pensions, personal pensions, and AVC accounts, of course, because there is a massive variation in the performance between funds under different company schemes and also funds across different providers. So many clients I meet in the pharmaceutical sector, for example, would have their pension with Irish Life, who have a massive share of the corporate business. And just before I move on, let me stress that Alpha Wealth are an independent company. We, can arrange products and pensions from every provider in the Irish market. So I've no vested bias in suggesting one over another. But if you take Irish Life, for example, many clients we meet would be invested in a risk level 5 fund for their pension, which would be a moderate to high risk fund, 5 on a scale of 1 to 7. And it would be appropriate given their term to retirement for a lot of people. Irish Life's main risk level 5 fund, a fund called the Multi-Asset Portfolio 5 Fund, has done 12.5% over the last 5 years, which is terrible for a medium to high risk fund. They also have a fund called the Consensus Fund, which a lot of people have exposure to in their pensions. And even though it's the same risk level as the Multi-Asset Portfolio 5, it actually has doubled the returns. Now, if we go outside the realms of Irish Life to Zurich, for example, who my pension is with, their Prisma 5, also risk level 5, has done 41%, which is nearly double again. So the message there to people is that if you are restricted to a company scheme, get some independent advice and make sure that you're getting the best options in that scheme. And if you're not restricted to a company scheme, for example, if you have a company scheme that you've moved on from, you can transfer that company scheme outside to another pension provider, or if you are, I suppose, self-employed or have a personal pension, you can choose any fund as well. So it's about getting that independent advice and always making sure that you're getting exposure to the best out there. When you guys were looking at my own pension projection earlier, I'm sure some people were wondering how I could get my hands on my pension from 55. And I still meet a lot of people who are under kind of a false misconception that they can access their pension until 65. I think that's down to the fact that the state pension isn't payable till 66, and a lot of company pensions will say that their normal retirement age is 65. But just so we're clear, the majority of pensions can be accessed from 50. So pretty much everyone on the call can retire from 50 onwards, I would think, if their fund is high enough. Even if your scheme rules don't allow, you can transfer your company pension to something called a personal retirement bond if you leave your company, which allows the access from 50. And that can also be done with old schemes. So there's a massive opportunity for anyone on the call who has an old company pension scheme that from a company that they've moved on from. As I evidenced in the earlier slide, this also offers more choice and better fund performance than most company schemes allow, because most company schemes are restricted to a limited range of funds from just one provider, and it's not always the best. Just a bit of caution as well for anyone who is planning on maybe amalgamating pensions, so as in moving an old company pension into a new one. I would recommend to get independent advice before doing that, because it can actually be advantageous to have separate pension pots, and you can find that you lose a lot of options by amalgamating. So whether that's keeping your old pension in the old company scheme or putting it to a personal retirement bond, it can be quite advantageous to basically facilitate an early retirement or a phased retirement. If you have all your pensions in the one scheme, all of your money is tied up until you leave or retire from the company you currently work with. Whereas if you have a separate pot, you can access that pot of money while still continuing to work in your current company. So a good example would be maybe someone who's 58 and wants to go back to 2 or 3 days a week. They can draw on their older second pension pot to supplement the reduction in their income from reducing their hours, and then maybe in their later years again they'll draw on their main company scheme. But if they don't, if they've all their pensions under the one house, they don't have that option. So look, just important to get a bit of advice there, and AlphaWealth can help people to review their old schemes and their options and give advice around that if needed. So just moving on from pensions, I just want to talk about another tax efficient scheme to reduce the amount of tax that you pay. And it's basically a revenue-backed scheme which allows people to invest in qualifying Irish companies. The minimum you can invest in these companies is usually about €5,000. And just on an example of €5,000 here, if you were to invest 5,000 in this scheme this year, when you do your tax return next year, revenue would give you €2,000 back on your 5K, so a 40% tax rebate for top rate taxpayers. So basically that makes the cost of the investment only €3,000 to get 5,000 in there. Now, the scheme is typically 5 years, and after the 5 years, you'll get your initial 5,000 back, plus interest from the company that you invest with, which is usually in the range of about 25, 28%. So that could be 1,400 interest coming back to you. So 6,400 coming back in 5 years on an investment that had a net cost of just €3,000. So it's 100% of a return. The scheme is called the Employment Investment Incentive Scheme. A lot of people don't know it exists, but it is the only I suppose, vehicle that you have in Ireland to get tax back at a very high level outside of your pension. And it also extends to multiple sources of income, including rental income from an investment property, your PAYE earnings, or any other income that you might be in receipt of. And the limits that apply to pension contributions do not apply to EIS. So somebody can max out their pension based under the scope that I showed earlier, and then contribute to EIS to further reduce their tax bill. Alpha Wealth's role as a financial advisory company is to look around and identify some of the best companies in that space that are raising EIS capital. And one of the companies we raised money for last year, who are also raising capital again this year, is a beer and spirits company called Blacks of Kinsale. They're around since 2013, phenomenal company. The company was valued at 15 million euro in 2021. We are waiting a more up-to-date valuation. I would think it's much higher at this point. Their revenues last year were over 2.5 million, and they basically have a wide range of products, which includes craft beer, whiskies, gins, and rum, which they've got multiple awards for. Basically, they're using the EIS funds to build a new multi-distillery and brewery down in their site in Kinsale, which is now nearly finished. You can see the article here in the Irish Examiner about it. And they're paying a 28% return over that 5 years, in addition to the 40% tax break. So we think this is an excellent opportunity for people to generate a good return on an investment and reduce their tax bill further outside of maybe what their company share savings schemes or pensions might allow, and also diversify their overall exposure, of course.
David, just have another question just coming in relation to EWS there. So say, for example, if I invested 10,000, am I taxed on the rebate I received from the government the following year?
No. So just going back to the workings of it, if you invest 10,000 euro, you're basically offsetting that investment against your income in the year of the investment. So revenue are giving you a 40% tax rebate of the tax that you had suffered. So that's all into your bank account, no further tax to be paid on that. Now, what you do pay tax on is the 1,400, which is the small interest. Now, those that have shares will know that you have an annual tax-free exemption against capital gains tax, which is 1,270 euro. So in this example, if your only gain was 1,400 in that year, 1,270 euro would be tax-free, and you would be paying 33% tax on 130 euro, which is, a very, very small tax bill of about 43 euro there. So it's only 43 tax to be paid, basically, in this case of investing 5,000. So you're still getting, over a double your money scheme if done right, and we, pick a good company, of course. So just moving on from that, I just want to talk about company shares and company share saving schemes. So many people on the call today might have the opportunity to participate in purchasing shares through their company, and many people are really confused with how to benefit from it and what to do with the shares. And I suppose the general rule of thumb, or the advice I would give to anyone, is firstly, it's an excellent benefit. So continue to buy the shares, particularly if there's a tax saving on the benefit of you receiving those shares. My understanding is that there's usually a 3-year period whereby if you hold the shares there's no, say, income tax or BIK arising on the cost of you receiving the value of those shares. But after that point in time, there's no further benefit to you holding, all your money in the one company share. So the advice I give to people is buy them, and when they vest, sell them. There's 2 reasons for that. The first and most important reason is to reduce your risk and diversify, because I meet people that have significant amounts of money in the company share with the company they work for, have little to no other investments, their pensions are underfunded, they're paying car loans, and they're left with 100 grand in one company share, which is, to me, is bonkers, because you're putting all your eggs into one basket and speculating that, I suppose, the price of that share will continue to rise, which respectfully nobody knows the answer to. So it's a much better strategy to diversify your overall holdings. The second reason, as I kind of alluded to earlier, is to benefit from this annual exemption against capital gains tax. So basically, what you will pay tax on is the uplift in the value of the shares. So if a share is 100 a day today and you sell it for $120, the uplift in the $20, you will pay 33% tax on it, but you do have an annual exemption of €1,270 to offset against that. So it's a use it or lose it thing. Do it every year, do it regularly to benefit from that. The tip I give to people is don't end up with more than 20 to 30K of shares in the company that you work for, because there are other ways that you can still get growth on your money, get exposed to stocks at a much lower risk level. So the easiest way to diversify your shares, in my mind, is to liquidate them and reinvest them in a fund, such as the Zurich Dynamic Fund here, which we would use for a lot of our clients. The Dynamic Fund basically is a fund with an incredible long-term track record. It's around since 1989. And you can see here that there's 650 different company shares within this fund. So as I said here, what's the point in you owning shares in one company that you work for when you can own 650 company shares within this fund? It's managed for you, so it's very hassle-free. It has a long-term track record with average returns of about 11% per year since the 1980s, which you can see here, 10.7% annualized on average, even at a low point in the market now. So you can still get equal, if not better, returns than the share that from the company that you work for, while taking a lot of risk off the table. You can access the money at any stage at no penalty. And for those of you who might be looking to take further risk off the table, there are similar funds like this at lower kind of risk and reward levels. So there are, multiple options for people, but it's about getting, advice around it, of course. And we're happy to discuss this with anybody who wants to explore it. What I just want to talk about briefly is just the changes to BIK on company cars, which came into effect from this year. And while I appreciate it might not be relevant for everyone on the call today, it might be for some. So those of you who have company cars might be aware that from this year onwards, the calculation of BIK is going to change to a combination of mileage and CO2 emissions. And the bottom line is it's much more expensive to own a company car. So a car that was worth €37,000 and doing 25 business kilometers per annum last year would have had a BIK of €8,880. Under the new regime, that rises to 12,500. So it's something that a lot of people are kind of struggling with, people that have company cars. And the other, I suppose, spanner in the works is that they have actually extended this to electric cars as well, who previously got relief. So the original market value basically is going to be reduced over the year. So all cars, including electric cars, will now be subject to benefit in kind over the coming years. There is some minor breathing space in the short term because the government have introduced a €10,000 reduction in the original market value of all cars this year. So it's not going to hit as hard this year, but definitely from next year, I think people with company cars should be looking at ways to mitigate against this. And look, it's there's not a huge amount you can do other than, the kind of four options that I set out here. One is simply to give back the car and use your own. Maybe a lot of people now are working from home mostly and they don't really need a company car, so it doesn't financially make sense for them to take a new car on board and suffer a high BIK for that. If you do have to take a company car, you could take a smaller or a less expensive car to reduce the BIK rates, or a more energy efficient car. People can also maybe opt to get a commercial vehicle which has no BIK and no back seats, funnily enough. They could opt as well to get a car allowance versus taking an actual car, which would allow them more choice in the car they go for, rather than just being handed a car that might cost, I don't know, 50, 60,000 new and suffering BIK on that.
Yeah, so two questions came in on that as well, David. So the first one is, I thought the government have rolled back on the changes regarding BIK.
My understanding is that they haven't rolled back on the changes, but they are reviewing it, and there is quite a lot of, I suppose, backlash against it. But one thing they have done is introduce this 10,000 reduction in the original market value this year to, I suppose, lighten the impact of it straight away and give people time to find an alternative. Now, unless something has changed in the last couple of days, but look, I could stand to be corrected there, but I believe that's the case.
And the second question is, what if you receive a car allowance annually?
So if you get a car allowance, you will also pay tax on the car allowance. Of course, you'll suffer BIK on it. But the point I'm making is that If you get a car allowance, at least it offers you more flexibility in terms of, like you might get a 20 grand car allowance that you can just use to purchasing, your own family car, rather than you just being handed a brand new expensive car where you're going to maybe suffer a much higher tax rate on that. Perfect. So just is that all the questions on that, Keenan?
That's perfect, David. Thanks.
No worries at all. So just what I want to talk about now is, I suppose, how we can save people money to kind of, achieve all the things that I was discussing. Because look, I do appreciate that things are challenging at the moment. I'm not living under a rock. There is a cost of living crisis. But I think, regardless of everything going on in the economy and the world, we do need to be proactive with our finances and make sure that we are getting the right advice to manage them. And Alpha Wealth can really help in this, because we can basically review people's main financial outgoings and look to reduce costs. I've rarely met a client ever that I couldn't save money for. And people can save significantly by reviewing things such as mortgage and mortgage protection, which people are still paying over €100 per month for, when they could be paying as little as 25 quid a month or less. Really shopping around on things like home and car insurance. I still meet people that are servicing car loans, even though they have large amounts of money sitting in cash, earning nothing, or maybe shares in the company you work for. If you have a significant amount of company shares, I don't believe anybody should be taking, a car loan and paying interest on it when you have money elsewhere, maybe sitting, earning nothing. And even look, if you're forced to have a loan, it's about, making sure that your rate and your repayments are as low as possible. Similarly, on the mortgage, there's a lot of talk about, rising interest rates, and it's about, us trying to help you to protect yourself from that. And then obviously things like health insurance, which I appreciate, some people will have through their employment packages, but if they don't, it's about, making sure that they're availing of all the online discounts and offers that are out there. And of course, reviewing any existing financial products that you might have to get a second opinion and try to reduce fees. And it's about, trying to envisage all the savings that can be gained through this process with ourselves during a review, and thinking about where that money could be better to redirect it for yourself. This is just a quick case study of a client I was dealing with a couple of weeks ago. And when we done a bit of a financial review, we found out that their pension was underfunded, and it wasn't going to deliver enough income for them to retire comfortably, and they needed to pay another €600 per month gross into that to correct the deficit. And the issue is that they couldn't afford to do that because their current expenses were too large. And I think the issue is that the majority of people stop at that, write it off, and don't seek advice. This client did seek advice. She came to us. We had a really good look at her finances and gave her advice in terms of managing it. And I found out that she was paying a €400 per month car loan that had 10 grand outstanding on the loan at 8% interest. All meanwhile, she had 30,000 in savings, earning 0% interest, 10,000 roughly of shares in the company that she worked for, with 5,000 vested coming back to her, which were only growing at an average rate of 6% per year over the last couple of years. And the advice there was to use the 5,000 of the vested shares plus 5,000 savings from her cash balance, declare the car loan, and eliminate the repayments. Now, remember, saving €400 per month in car repayments means putting a lot more to your pension because of the relief. So this person can actually put €670 per month extra to their pension for the same net cost of servicing the €400 per month car payments. So the pension deficit is corrected. Then by doing that, they're going to reduce their tax bill by €3,216 a year. They're saving 8% per year in interest, which is the interest they were paying on the car loan. They're earning a much bigger interest rate in the pension, and whereas they had cash earning 0% and the shares of only 6%. Finally, the client's exposure is much more diversified, as they have more money going into well-diversified pension funds just versus one company share. And I suppose the key takeaway from this is that there is zero additional expense to the client. I did not ask for a cent extra to spend from that client to achieve all this. It's just about rejigging things and getting the right advice. Now, we do offer a full financial planning service to cover all the things I just discussed, and case studies like this for everyone on the call today. And we do like to reward the people that come onto our webinar. So we do offer a reduced rate for that financial planning review. which is just €99. It's usually 199, so there's a 50% discount there for people who come onto the webinar. And some companies, by the way, do charge up to €1,500 for the same service. I'm happy to show examples of that if anyone is unsure. Basically, that it entails reviewing your current financial situation and plans, setting financial objectives and goals such as clearing your mortgage, planning for education, retiring early, providing these cash flow models to predict your future financial situation, mapping out a financial plan to meet your objectives, and all while identifying ways to save you money, reduce your tax, and make your money work a bit harder for you. So some of the other areas that we can help with, obviously, as I said, are things like mortgage advice, reducing debt, protection reviews, pension advice, estate succession and tax planning, children's education savings plans, which you can find out a bit more information on the webinar I'll be doing on the 18th of April, financial planning and retirement planning, and tax-back investments such as the EIS. And if anybody would like to hear more information on the EIS opportunities that are going to be coming up over the course of the year, look, feel free to reach out to us. So look, my own contact details are there if anybody wants to get in touch. Do appreciate everyone's time for coming on, as I said, on the Thursday before Paddy's Day. And look, I might just spend the next minute or two just opening it up to questions for anybody who wants to ask one.